Well, there's fresh news of pain in the financial markets from the mutual fund end. The NBFCs continue to say that they are not receiving any money from banks for the inevitable asset liability mismatch because of the moratorium granted to their borrowers. The stock markets are reflecting the pain of the financials. A lot has been done. There's no taking away from that. Just let us remember, it was only on March 25th and 26th that the overnight money in the market, the repo rate was going at 5.15. Today, overnight money, even according to the policy rate, is 3.75. I mean, that's a huge, almost 150 basis point policy rate cut. And then if you go to the actual overnight money, which is in the tripartite repo, the TREPs, then it's as low as 2%. So cost of money has fallen by 300 basis points. Money is as cheap as 2%. But it is not available to those who most need it, as is very obvious, which is why you have so many people seeking redemptions, because corporates want money. They have no revenues. So where does this leave us in terms of the next steps? From the regulator, has he fired all his bullets? Does the RBI have more bullets? And what next from the fisc if the Reserve Bank is reaching a dead end on some issues? To answer these questions, I have with me three people who are eminently familiar with the topic. I have two former bankers first. Srini Varadarajan, who was formerly heading the Deputy Managing Director at Axis Bank, and Anant Narayan, who was formerly with Deutsche Bank, Citibank, and Standard Chartered banks as well. I've called former bankers because current bankers are a little wary of saying why they did not put money in the TLTRO. That's why I have former bankers. And then I have someone who can speak for regulators and for the industry. For both regulators, SEBI and RBI, I have with me former Deputy Governor of the Reserve Bank, Mr. H.R. Khan. Gentlemen, thank you very much. There is a lot of pain and there is a lot of ask, and therefore what you say will be seminal. Let me come to you, Srini, first. The TLTRO, the targeted long-term repo, which was announced by the Reserve Bank and launched this week, has not found takers. Only 50% of the money has been taken by the banks. What is the message from that? What tweaks are needed?
Lata, if you look at that TLTRO, whether it is 1.0 or 2.0, I don't think so it is doing much as far as corporate bonds are concerned, especially for NBFCs. If you look at the list of people who have got money through the TLTRO, they would have got money anyway. And if you look at what the RBI governor said in the last conference, where they lowered the reverse repo rate, they said there's so much money coming to us that we need to lower this rate. So price is not an issue because the liquidity is available with banks. They are not willing to lend beyond a certain set of participants. So whether it is a liquidity which they have with themselves or which comes through a TLTRO, the money goes to the same set of people. So it's a question of risk appetite and what sort of risk banks in the current environment are willing to take.
But, let me first get a fix on the problem as well. As Srini is pointing out, it is not the availability of money. Some people are not getting it, irrespective of the cost and the availability. Some people are just not getting it. Ananta, first, can that be fixed? Because if 12,500 crore has been borrowed instead of 25,000, banks appear to be telling us that we can't find enough worthy candidates, investment grade candidates, in the smaller MFIs and NBFCs. Do you think one straightforward answer is to remove all these divisions, then more people, then the banks will have taken the money? What tweaks can you suggest?
I think, Lata, let's start with what the objective of TLTRO is. The problem, as you rightly mentioned, is that some sections of the economy which are critical are not getting access to funds. Let's start with the sectors you mentioned, the MFIs, the microfinance institutions, and some non-bank finance companies. They're struggling to raise money. Why is that important? It's important not just because they're individual names, but because it's a very, very interconnected system. Banks, NBFCs, mutual funds, pension funds, etc., and the real economy. So if one big chunk of that starts to falter, the entire ecosystem can be a problem. So the intent is, let's try and push money into these sectors. Why isn't money going from banks to these sectors? there is no shortage of liquidity. Rates are also very attractive. They're willing to pay very good rates at this point in time. The problem is there is a risk aversion amongst bankers because there is a question mark about the asset quality of some of these borrowers. There's also a question mark of how COVID-19 will impact some of these borrowers. And these are tough questions to answer. So if you are sitting with this trust deficit and this fear, no amount of cheap liquidity can make you lend to these people. So at a time like this, unfortunately, which is completely out of syllabus, somebody has to step in and say, you know what, I'm going to provide to you the credit comfort for you to lend to these people. Now, this is not prescribed in any standard textbook, unfortunately, because these are unusual times. It's very difficult for the RBI to step in and provide that credit comfort in toto. It can provide liquidity, it can lower rates, which it's doing. But taking on credit comfort beyond the point probably has to be the call of the government, because it will eventually have to use taxpayer money for this. So, we had a playbook for this in 2009, Lata, where the RBI and the government of India put together an SPV, which was allowed to buy corporate bonds issued by NBFCs for short periods of time in order to take on credit risk at a time the market was not giving them the credit risk and provide liquidity and funding to those institutions. That fund was never utilized because things, got set by themselves. But something like that is required now, where an extra party comes in and offers the credit comfort, which the system is not willing to take.
Okay. Well, I think we've got Srini back on the line. So, Mr. Khan, before I come to you for solutions, you have to provide them. You are the regulator in this group. But let me extend the problem beyond NBFCs. I mean, one of the reasons why companies like Franklin Templeton have a problem is that those who are giving them money to invest are a little worried about some of the investments they are making, especially in NBFCs. So, Srini, if you can just delineate, can this problem get a little out of hand now? Because it's not just with NBFCs, now it is expanding to the MFs also. So, can you give us an idea of how bad this can get, or not terrible, but just an idea of whether the problem is bigger than just NBFCs?
And the system is interconnected, right? So basically, if you just sort of extrapolate the situation where people lose some amount of trust and faith in debt mutual funds, and other mutual funds also see redemptions, and they are forced to sell paper, say a AA paper or whatever, credit spread starts widening, and therefore that contagion sort of can spread. So it is important to arrest the whole issue by providing liquidity by someone willing to take the risk. Exactly as Anant was saying, you need someone to intermediate the credit risk today. Banks have never been an investor in corporate bonds. Other than our 2-3 banks and some foreign banks, they have never been an investor in corporate bonds. You can't expect them today to come and buy all the corporate bonds which someone wants to sell. So the buyer is either an FI who is right now in exit mode, or there is no, I think the whole thing of trying to have a large portfolio and trying to sort of manage redemptions today is difficult. So there has to be an intermediary who's intermediating the credit risk here. And that is something which we desperately need today to make sure that the contagion doesn't spread.
So what are you saying? You think the government should announce a first loss? Who is the intermediary?
I think what Anand was saying, you set up an SPV, government provides the equity, and that clearly, I don't think so. The issue a question of loss here. I think most of these credits will ultimately end up being paid back. It is a question of today, if you want a buyer, I think that buyer is not there. You need to manage the situation today by providing some credit backstop and therefore liquidity. And it is in my view, we are making the problem bigger than what it is actually.
Okay. Well, Mr. Khan, we spoke to AMFI as well, the Association of Mutual Funds. So, I'll tell you some of the solutions that they want immediately. AMFI wants the RBI to announce a line of credit. That's it. Bankers who said that they did not invest in the TLTRO, second TLTRO, said that if a first loss is provided by the government for NBFCs and small MFIs, we may be still willing. NBFCs have been asking for the moratorium to be available to them. These are the three primary asks. You think this can be easily granted by Reserve Bank and, of course, first class by the fisc?
I think the menu of options you have indicated have to be looked at very closely, and there is nothing wrong at looking at them very closely, as both my fellow panelists have said that these are unusual times. So we have to look for unusual and unconventional solutions. So for the line of credit and up to NBFC is concerned, in the past we have given in the past crisis through the bank. So that is already playbook is available. Fast loss is something everyone is talking, not only for NBFCs but also for SME borrowers, and enhancing the credit guarantee component which is available with SIDB. And third is in terms of moratorium, which is a fair ask, because not many of them are in a position to issue papers which will meet the investment criteria, nor they can issue at this current juncture any corporate paper. The fourth option, to my mind, would be create some market making in corporate bond market. So how do we create that market making, which some of us have been pleading for quite some time, and in fact for once it looked that RBI is going to accept that. That is creating a long-term repo operations involving corporate debt. And there, once there are market members, they know that there is a backup provided by the central bank. I think that will provide a lot of vibrancy to the corporate bond market. So that long-term repo in corporate bond market will provide that sort of a backstop and provide some facility to some of the market makers who will come forward, and there will be some activity in the secondary market in corporate. So these are some of the options one has to look at. Okay. But going forward, the major issue as...
Mr. Khan, yeah. Mr. Khan, 1 minute. Mr. Khan, 1 minute. I do want, going forward, what steps RBI should take, but I have not been able to quite get my hand around why is the RBI so wary, for that matter even SBI, of allowing moratorium for NBFCs. Why is there so much to and fro? March 27th it was announced, still not resolved. What's so big about granting them?
I don't know what is the conversations going on between the bankers, IBA and RBI. But my sense is that possibly RBI is thinking, since they are getting LTRO, they should not get it. But as you have seen, LTRO is not really working that well, and it may not help some of those NBFCs and MFIs who don't get that paper, and there is a lot of risk aversion, as Anant has mentioned. So I think in addition to that, this moratorium, back-to-back moratorium, is something which has to be considered, and considered early. I agree with that.
Okay. All right. Gentlemen, we have to take a break. It's only a minute. We are back, and we're going to continue the conversation with the three veterans and check out a short list that can easily and immediately be done by the regulator and by the government. Welcome back to this special discussion where we are speaking to two veteran bankers and a veteran central banker as to how we can address the festering problems in the financial sector. The new one that has been added, of course, is one debt mutual fund liquidating 6 of its funds. So now it's not just an NBFC issue, it's now expanded a little bit to the fixed income mutual fund segment as well, and so we better act quickly. Okay, now I'm really looking for solutions. Anant, what is first off the block for the RBI? In fact, we thought even this morning the Reserve Bank could announce a line of credit to mutual funds. Do you think that the first steps that the Reserve Bank can announce even over the weekend could be line of credit?
I'm going to go slightly broader. Give me some room out here. First thing for the RBI to do is to ensure that the government is adequately funded, both state and central governments. Things have become better, yields have become better, but maybe a long-term open market operation purchase program to at least ensure and assuage us that state governments will no longer complain and say they don't have money. So let's take care of that first. Second, let's get, as Mr. Khan said, let's get RBI accepting corporate bonds as part of collateral for repo operations. This was recommended way back in 2016 by Mr. Khan himself in the Khan committee. It's still waiting. I mean, how long will we take to start accepting this as collateral? You know, we're not even talking about beyond that. Third, for this particular problem of the mutual funds, look, we are not talking about distressed debt here. We are talking about good quality paper. There's about 10 lakh crores of AUM in debt funds right now, of which 6 lakh crore is outside of liquid and overnight funds, which means they have some credit element in it. You can't allow 6 lakh crores of market size to be under a question mark. Secondary market liquidity is simply not there. So you do need a solution there. The SPV, maybe sponsored by the government, funded by the RBI, is required to start absorbing some of the illiquid paper. These are not bad credit, these are illiquid, good quality paper. Let's start absorbing that and giving some relief to the market. Next, funding has to also go to the SMEs. Now, even if you give money to the bankers, they are not going to push money into the real sector because they are really worried about credit quality and what COVID-19 will do. Again, we'll go through the same trauma and the same debate. Again, we'll have somebody who needs to take on the credit risk. I think the government will again have to step in with some kind of, as you mentioned, maybe first loss on credit based on what taxes the SMEs have paid in the past, some kind of credit comfort so that money can be given to these businesses in turn to pay their payrolls and to pay the employees, so that money keeps going in the system. That is, I think, going to be extremely important. Last bit, we will have a lot of distressed assets growing up, some of which are past pre-COVID-19, some of which have come through COVID-19. We again can't close our eyes to this. They will have to be resolved. Again, some kind of fund from the government will probably have to come in to be able to take care of these stressed assets. A TARP of some kind, a bad bank, something has to happen. All these 5 things have to happen, Lata, over a period of time. They won't happen overnight, but we have to start showing that we are walking along these steps.
Okay. Well, actually, I wanted to toss the question to Srini, but very quickly, on Twitter and on WhatsApp, I'm getting questions from other market veterans, and this is a banking veteran. He's asking why only a long-term repo for corporate bonds? That could be tricky. Why not, for starters, a repo, albeit with a short term, up to say 180 days? You think that will be a good signal, Srini?
Yeah, I think when Anand mentioned long-term repo is basically saying that liquidity, RBI should accept corporate bonds as collateral and provide liquidity against that. Meaning you're talking of the LTRO or you're talking of acceptability as collateral. I'm not clear on that, but clearly accepting corporate bonds as collateral is whether it's long-term.
This is coming from a banker. He's only asking, why are we only talking long-term repos for corporate? Why not a short-term repo? I would assume it's a TLTRO.
Yeah, I think when your fund liquidity is assured for the long term, you are willing to take some more risk. Whereas if you're doing a short-term repo and you want to, when you start lending, I think you do not want to run the refinancing risk. That's why the LTRO becomes useful. If I want to add to what Anand was saying,
okay, but
can I do that?
Yes, please go ahead.
Yeah, basically, I think a lot lies with the government.
Yes, please go ahead.
With the RBI. Lot lies with the government and less with the RBI, because RBI has provided the liquidity. RBI clearly can do a little more in terms of making sure that availability of credit to the right segments. That's what we discussed in terms of corporate bond being acceptable as collateral. But I would like to sort of go a bit deeper to what Anand was saying. I think trying to use the banking system as an intermediary to do a lot of this and trying to say whether it's first loss or whatever the government provides, I think trying to use the entire system is not going to be easy, because each one is not aligned to what ultimately needs to get done in what time frame. So it's important to appoint nodal institutions for each segment. My thing would be appoint COVID care institutions for wholesale, SME, retail. They would set the framework, they would draw the rules, and anything which is lent incrementally as part of a COVID portfolio and over the next 12 months should have a separate dispensation. Ring-fence that portfolio, have a separate dispensation,
yes,
provide equity to absorb the risk, and clearly that's the way to go, rather than trying to say that I have some rules now, all of you go and do this, because everyone's looking at the other person and no one is doing it. So we need to appoint some nodal agency for each segment who's going to take ownership to make sure that the issues related to the segment get resolved. Otherwise, this is a wound which is not going to heal, but a scar which will stay forever.
Oh, right. No, I take your point. Actually, we were all expecting something from the government. An economic package was what kept the stock markets up and alive on Thursday. The hopes are not dying away at all. But Mr. Khan, therefore, that is my question to you. There have been suggestions for the Reserve Bank to give line of credit to MFIs and some back-to-back refinancing of NBFC loans. Please tell us what the government can do at this juncture. Also, one, because an economic package is expected, but I want to give you just one warning. What our sources told us is the top echelons of government don't want to be seen as pandering to the corporate sector. They want to really help the broad masses. That constraint of not wanting to be seen as a soot boot ki sarkar is very much there, and that is delaying the economic package probably. So what would you advise the government?
No, we are getting into the realms of political economy. So I think this is a time, in fact, I have said somewhere else also, this is a time for quote unquote some sort of a national consensus on building on this. I think government and opposition, they have to be on the same page, because this is an unprecedented crisis. So there is no point somebody getting a brownie point against the other. This is a crisis of humongous proportion. So we have to put aside all our political bickering and rise above that. So the fact remains, you have to help masses for their well-being. You have to help the
but what steps, sir? What steps?
Corporates keep the economy running, and they create the jobs. So it is not one at the expense of other. There is no question of food.
No, Mr. Khan.
This is coming to
Mr. Khan, we're running out of time. Therefore, some 1, 2, 3 from the government.
No, one is quite often it has been told that some first-class structure has to be created. And government has to bring in some money, and RBI can also put in some money. Let me add that RBI has not exhausted all its ammunitions, because FISC has a problem. Monetary policy is doing heavy lifting, but FISC can go some more steps it can take. And whatever has been announced is less than 1%. And if you talk of those SHG loans and front loading, it is even 0.5 of GDP. I think they can go for another 2-3 percentage points of GDP easily, and there are many ways available for funding that, including tax-free bonds, going for austerity measures, part monetization happening through RBI. So funding can be arranged for another 2-3 percentage of GDP going, and immediately in the context of NBFC, which you started your discussion, and the line of credit is something which is available in the playbook. So that can be activated.
Yes. All right. Okay, sir, that's a bunch of measures all of you have put on the table. Unfortunately, out of time. Let's hope that the fiscal package from the government comes sometime soon. Ideas are not wanting, and we have a rich list of them from our guests today. Thank you very much for watching this special show. Stay on with CNBC TV18. There's more lined up for you.